my name is Simon Gibbins. I'm the CFO of FTSE 250 electronics group discoverIE. People also call it discoverIE, which stands for Innovative Electronics. And that sort of neatly sums up what we are. It's sort of innovative, customized electronics. And that sort of leads on to the next slide, where, just to help what we are versus what we're not. So we design and manufacture customized electronic components for industrial applications. It's industrial. We're supplying OEMs, and this is the more niche, high margin, longer life, part of the electronics market. We're focused on, 4 what we call target markets: renewable energy, the electrification of transportation, medical, and industrial connectivity. And these are all, long-term, strong growth momentum markets. We're an acquisitive company. We've made 20 acquisitions in the last 10 or so years. It's a decentralized model, which allows the companies we buy to continue to be entrepreneurial, to continue to do what they're good at, while having our, strong governance and controls underneath them. We're a capital-light model, and that means that we are very cash generative. What we're not, on the right-hand side, we're not a distributor or a contract manufacturer. They are, lower margin businesses, and much more cyclical. We don't supply, standardized electronics. Again, it's a very competitive part of the market, driving much lower margins. And we don't supply consumer electronics, which is typically, much shorter type lives, and also very competitive. It's an organic growth and acquisition model, as you guessed. The organic growth, very much comes from, driving sales through those target markets that I mentioned, striving and driving to achieve operational efficiencies as we develop, and certainly delivering, strong cash flows, and all augmented by, high quality acquisitions. And you can see that's driving. If you look at the bottom of that, bottom right hand side of that chart, it's delivering, really strong financials. So since FY18, we've grown sales. It's 19%, CAGR a year, which, splits roughly 50-50 between organic sales growth and sales we're achieving from the acquisitions we made. Operating profits are up 34% CAGR in that period, and EPS is up 26% CAGR. And as I said, we're generating a lot of cash, and we convert it. We sort of measure it on, how much profit we convert into cash, and we're averaging around about 100% conversion in that period. If you look at the chart at the top, really, strong, strong returns to shareholders. So on average, over the last 3 years, 5 years, and 10 years, we're delivering, 20%, per annum, 20% CAGR growth in TSR, including a dividend which is growing at 6% a year, which is roughly at the moment is about 1.4% yield. We're an international company. We've got operations in 20 countries, and we're selling into 66 countries, and that's very much to support, a global base, our global customers. We've got sales of around 400 million, with 10% of sales in the UK, 50% in the rest of Europe, and 40% between North America and Asia. We've got 5,000 employees, 30 manufacturing sites, and that all helps, flexible production. We need to be flexible because of the size of batch sizes, and it also allows us to support sort of localization, local supply. A chart just to give you a look at the history of the company. It was actually formed, a while ago. It was a commodity distribution company then. Nick Jeffries, the current CEO, joined in 2009, and I joined in about a year later. And we've been, we devised and followed the same sort of strategy that we're continuing with today. And you can see that we've made 20 design and manufacturing acquisitions. That's the orange boxes along the top in the last 10 or 11 years. And in the meantime, we've cleared out non-core businesses, including latterly right at the end, we sold out of distribution a year ago. And so we're now, a pure design and manufacturing group. We have used the blue boxes. We've used equity to fund transactions in part as we proceeded, but that's a much lower part now as we focus on becoming much more self-funding, self-financing of our acquisitions. And just a note in the middle, Bruce Thompson is our chairman. You might want to come across Bruce. He was 25 years CEO at Building Diploma into a highly regarded FTSE 250 company. Similar model, buy and build. So his coming on board has been great. So why invest in discoverIE? There's five key factors I've noted down here. We're in these target markets, these strong growth markets, which should continue to grow. We're making highly differentiated products, really important for our customers. It's a strategy. We're continuing to follow a strategy that we've had for the last 10 or so years, and that's delivering strong financials, and as I showed up front, some decent shareholder return. So taking those one by one, the markets we're in, these four target markets, they're all markets which have strong growth, will continue to grow. The forecasts are very much about that. So if you look at each one, renewable energy very much driven by the need to decarbonize, important in this age. So too with the electrification of transportation. So massive markets potential with both of those. Medical, we're all sort of living longer. We all need better treatments, better diagnosis. So that market will continue to grow well. And finally, industrial connectivity, that's sort of automation, robotics, the Internet of Things. That's sort of in everything these days, and it's even will just continue to be more so. But all of those markets are UN SDG, so sustainable development markets, which is really important to us. We take the whole environmental matter seriously, so that's key for us. If you look at the top chart, you can see that these target markets, so we 77% of our sales are in these target markets, and they're growing over the last 6 years nearly twice as much as other markets, so 12% average growth per year in that 6-year period, and 10% for the group as a whole. Highly differentiated, we're making highly differentiated products. We make customized components that help our customers differentiate their product. So they're critical parts for the customers, but actually they're a pretty small part of the overall cost of makeup for the customer. So actually that's allowed us to continue with high margins, and despite the sort of inflationary pressures we've all been witnessing, we've been able to maintain pass costs on and maintain stable margins. We make a very broad range of technologies, which would include magnetics and sensors, controls, and wireless connectivity. Sensors is a great example. You've got it on the chart there. Sensors are, as you'll know, are in everything. There's heat sensors, pressure sensors, motion sensors, and you can see on that chart how we use, how we were able to sort of develop, our sensor products into each of the target markets. the strategy. It's a clear and proven strategy. It's actually a simple strategy. We've been applying it for over 10 years. It's good, growth in sales. I'll say we're delivering sort of 10% average growth in the last 4 or 5 years. Move up that value chain. That'll come through, operating efficiencies, and also as we acquire high quality growing businesses. And we're also looking, we've been looking to broaden the business out. It was a UK and then a European business, and our products are equally compatible for North America and Asia. So we've been striving to grow there to support our customers. All of that is underpinned by the need, and what we are doing is delivering strong cash flows, and also the very important factor of reducing our own impact on the environment. And so in terms of those, that strategy, we've been setting ourselves targets. These have all been externally published targets that we set ourselves. We've been doing that for the last 8 or 9 years. Targets at the top, you can see key strategic indicators focused on growing our operating margin, growing our sales outside Europe, increasing our target market sales, and reducing our carbon footprint. And if you look at the operating margin, as I said, we started off, life, Nick came on board. It was a loss-making business, back then. We built it into the margin now is 11.7 reported in the first half, and our target is 13.5. And when we achieve that target in FY25, we'll then push that target even higher. We've increased that target about 4 times already to date. If you look at the table below, that's our key performance indicators. That's focused on growth in sales, growth in EPS, and growth in dividend. The achievement of at least a 15% return on capital employed, and the final 2, very importantly, are about the ability to convert our profits and into cash flow. We're delivering well on all of those. And these are delivering, as I showed up front, strong, financials. So 19% CAGR growth since FY18 in sales, and in fact we've just reported that our year is the year ended March 23. So for the first half we've just reported another 26% growth in top line sales, 34% CAGR growth in operating profits since FY18, and we've just reported 42% for the first half growth, and 26% CAGR EPS growth. And so we've just reported 37% growth in 23. In terms of consensus, the market's looking for the full year FY23 around 430 million of sales and 48 million of profits. So that just shows you the size of business we now are. Finally, look at our capital allocation. We've got again, it's a simple approach to capital allocation. The chart on the right is the capital we've used over the last 5 years. So 350 million of capital. Basically we invest in any sort of organic capital growth projects that we can. That's 27 million, so that's over 5 years, is sort of averaging less than 2% of sales. Hence what I talk about is a capital light model. We're investing in that progressive dividend, and the balance, which is nearly 250 million, has gone into acquisitions. And in terms of where it's come from, nearly half of that capital has come from free cash flow that we're generating, 100 million or so from equity, and the balance from debt from our balance sheet and from the disposals, the non-core disposals we've made. And if you look at the bottom chart, our target in terms of gearing on the balance sheet is, we've always externalized that. It's 1.5 to 2 times, and you can see we've always kept within that limit. And finally, if you look at gearing as we exited the first half, was 0.8, and we have we've got a very good pipeline of acquisitions, and 70 million spent on acquisitions would take the gearing to about 1.6. So we've got plenty of headroom on our own balance sheet, for acquisitions, and we've got a good balance. We've got a good pipeline. So with that, I will conclude and pass it over for questions.
Thank you very much indeed for the presentation. A lot of questions about the acquisitions and the acquisition strategy. So I guess kind of start off, what parameters do you use for acquisition? What are the main drivers?
Well, we certainly look at the financials. We're looking at what a strong companies that are in good condition, they're growing, they're either in our target markets or capable of being in our target markets. We're looking for to deliver, with multiples typically around about 8 to 10 times is where we pay, and we're looking for them to within at least 2 years to achieve a return on investment of around of 15% is our target.
And how do you,
we also very key, just to adding to that, we're also very, very key to that is the quality of the management team. The management team need to have this, they need to be entrepreneurial, they need to sort of buy into our model, and the business sort of needs to fit. So while we run it as a decentralized business, we want them to look, to work, operate with those other businesses and try and sell their products across to each other's customers.
So you aim to keep the management teams in place?
Yeah, typically, we will set typically set an earn-out target over 3 years. So we want them to stay. They don't always stay. Some are retirement sales. We've got a very good track record of bringing in new management to take businesses forward, and sometimes managements do change, and again we've got a very successful record of bringing in new management to take businesses onto the next level.
And as you grow, do you aim to acquire larger companies, or do you get I guess benefits of scale?
We're certainly looking at to continue, what we call bolt-ons. As we're getting bigger, we're sort of clustering our businesses around a sort of common technology. So we have, we have 2 key clusters at the moment, which is a magnetics cluster and a sensors cluster. So that anything coming into that is what we'd call a bolt-on, and they would that gives us sort of bandwidth, and they will sort of report through to the the larger business, but we will we will look at bigger businesses. I think generally the size of acquisitions, if you look back, has grown, but the last acquisition we did was 5 million, so we're certainly still looking. Certainly get there's excellent value to be achieved from smaller deals. The multiples you can get are excellent, are super.
Got a couple more on acquisitions. Do the deals come to you, or do you go looking for them? How do they come about?
It's all of those. So we've got our own team. We've got an internal M&A team who are who scour looking at targets. We use our own management teams. Companies that have been acquired typically know the sort of companies they want to buy, so they bring opportunities. Obviously the banks are all over us with opportunities. We're known as an acquirer now, so we'd sort of expect to be on the on the list for any company that's looking to sell itself.
Okay, next up, the change attack. It's asking about IP. Do you own the IP? So I guess they're asking for the design and manufacturing. Do you own the IP or for the products?
Yeah, increasingly, it's quite a lot of it is know-how, and it is, it's but that is very valuable. But as we yes, all the IP itself belongs to us. They're not necessarily patented, but the IP does belong to us. It's not contract manufactured, as I said. Yeah.
Okay, next question is about where you manufacture. Where does most manufacturing take place?
Well, our biggest, biggest markets are over in Asia and Eastern Europe. So we got plants in China, Sri Lanka, India. Poland is large, and then Mexico is also one of our largest areas.
On China, any concerns about the outlook for China? Are you comfortable? And if you're not, are you able to move manufacturing out of China if you needed to?
Yeah, we see, obviously we're watching, China of interest. Our production, certainly through the whole sort of COVID side has been, hasn't missed. It's regarded as a required development. But we are capable of moving that. And we have moved production into China, and we've moved production out of China, and that's quite key to us. It's that's why we have sort of 30 manufacturing. We don't, while we when we do acquire, we occasionally rationalize some of the manufacturing, but it's quite, because they're quite manual or semi-automated businesses. There's not a huge amount of cost that you can save from doing it, and then that allows us to move production around if we needed to. Yes.
And on the shareholder register, this is a complicated question for me. Who are the major shareholders? What does management have? And who else are the main holders?
Lili, do you want to run through the major shareholders?
Sure. So actually, one of your previous guests, Impacts Asset Management, is one of our top holders. I have to say that Aberdeen Standards, or Abden right now is called, is our top shareholders. They actually owns about 12% of the company, and coming down is BlackRock, and then is Impacts, and then followed by Kempen, which is a Dutch investor. So we have a kind of top 10 investors owns about 50% of our shares, and they're quite diversified, and they've been long-term shareholders, and quite often many of them have been holding the company shares for years. So Abden has been our shareholders for more than 5-6 years now, and Impacts come on board about 2 years ago. And the rest of the register is basically all institutional investors, and the management team altogether owns about 4% of the company.
And just following that, the retail investor, the kind of people who are watching here tonight, is that significant at all? Then is that quite a small part?
Yeah, absolutely. I mean, previously we have many retail investors, and certainly from wealth managers' point of view, is that one of our largest shareholders previously, it's a wealth manager. But we still have many kind of wealth managers on our registers as well. Charles Stanley, for example, they still owns quite a large position. But over time, that as we get bigger, and especially when we get into FTSE 250, and we're seeing more institutional shareholders taking up positions. So yeah, that's kind of a natural migrations, I would say.
Yeah. The final question is about margin growth, and how do you achieve that? Showing on that chart that improving year by year, is that from cost savings, or how are you achieving that margin growth?
Yeah, well, it's a combination of operational efficiencies. So just we're very, very careful with costs. We put costs in carefully. We make sure that the increase in costs is less than the increase in sales. We're very, very keen on that. But equally, additive to that, we're buying high margin businesses. So they typically, businesses we're now acquiring are have their own operating margins of over 20%. So that, you know, that itself will be additive. So it's a combination of the two. You know, if you look at our you know, first half results, you know, despite sort of you know, the inflationary pressures that are on, we seek to achieve what we call a drop through of 50% of the gross margin. So if our gross margin's around 40%, we're looking for 20%, you know, increment to the bottom line from new sales, you know, which therefore drives you know, operating margin growth, and that's what we achieved, and that's the sort of history of what we typically do.
Lovely. Simon, Lili, thank you both very much indeed for joining us.